has Warren Buffett managed so successfully to transition from the traditional partnership culture that he began in to the corporate structure that Berkshire has today? And I think I'd also ask each of you what lessons you've taken away from that in running your own firms. And Whitney, maybe you could take that one first.
I think, he has been my role model, and I actually wrote to him the month I opened my firm in January 1999. And I told him I was a fan and had studied the way he'd done. I'd hoped to emulate him both as an investor, of course, but also in terms of how he ran the business. He communicates very openly with his investors. So sort of the opposite of the black box model that you see so often. He does I think to be a successful investor, you need to be able to marry arrogance and humility. The arrogance part we all got in spades. Basically everybody in this business. You don't go into this business if you don't have healthy self-confidence, because really if you think about it, buying a stock is an act of arrogance because you're betting that you're right and that everybody else out there in the market and all the supercomputers and everybody else is wrong. What Warren does so well, though, is he marries that with incredible humility. And if you go to his annual meetings, you read his stuff, he and Charlie look for ways to engage in self-flagellation and highlight their mistakes and saying, just because some other guy's making money in cocoa beans, I don't care because I don't know anything about cocoa beans. And so I've tried to incorporate that both into my investing philosophy and how I've built my business.
Paul?
I would just say he's had such a profound impact on me. One of the things that really jumps out at me, which I think is even more important than being a great investor, he's just a wonderful and terrific human being. And one of the things that defines that is permanence and stability and consistency and loyalty. He exemplifies those at an extraordinary level. And it's also time horizon is something that also jumps out at me. He looks at everything with permanence and over the long term, whether it's regard to the capital that he has available to him, it's permanent capital, long-tail reinsurance, whether it's the investments he makes in publicly traded securities, he looks out 10, 20 years. And when he buys a business, he's trying to identify if the CEO is really focused on the business far more than the money. And he tells them, it's that you own 100% of the business, you own it, you and your family own it for the rest of your life, and you can't sell it or merge it for 100 years. So one of the things that really jumps out at me that I've tried to employ is trying to be a first-rate person. It impacts everything you do personally and professionally. And then secondly, it permeates the entire organization. I mean, I've never studied a business that has a culture like he does, like he's created. And so that's part of what gives me confidence when I look to the future. And I've tried to take many of those qualities into my own business. We try to be very careful who we accept as clients. If they don't have a 5-year or longer horizon, we would prefer not to work with them, because the ability to make 5, 10, 15, 20-year commitments on the investment side requires you to have that quasi-permanent capital. And so for me, what jumps out is, again, the kind of human being he is, and then how he applies that permanence, consistency, loyalty, and stability to everything he does professionally. He's seamless, he's consistent, and I think that's a big part of his success.
Yeah, it's interesting, Tom, because just playing off what Paul said and also thinking about Seth's remarks in the previous panel, really, in order for a value investor to deliver ultimate value for your investors, you have to have the right structure. Seth talked about that a lot. And I think one of the problems in the money management business is so often your clients are much shorter term oriented than they think they are, and often more short term oriented than you are. Have you been able to apply any of the lessons from Berkshire to how you've structured your firm and determined who your clients are?
Yeah, I think so.
You hope so.
I hope so. I try, and but I'd say the thing that Warren offers us as money managers, probably the most important thing, is the example that he's led. Academic finance is very seductive, and it suggests that there's some methodologies, some analysis, some algorithms that one can use to come up with magic formulas and to deliver results without risk. Warren's existence is the one thing that we have as sort of our state's evidence number one against that unfortunately appealing, seemingly science-based reality. Warren has had, I think there's something like 4 years during which the price of his shares dropped by 50% over the course of being a public company. Things don't work well at Berkshire every single day. Every quarter is not perfect. The world knows that despite that, it's been an engine that's been extraordinarily rewarding. Were it not for his presence, we would fight with far fewer tools. When asked why the last quarter that we underperformed by 1/8 of a point wasn't cause for firing us because other people can manage the uncertainty more scientifically. There's no science to this, and his existence allows us to operate under the umbrella of trust that's come up over the years. My own particular business, I've taken away 3 points. The first has to do with tax law. Warren said when I met him in the early 1980s at business school to our class, one advantage the government provides is tax deferral of unrealized gains. Figure out a way to take advantage of that. That's a very instructive investment idea. So what you have to find are businesses that are capable of reinvestment. And that's a very rare number of companies. So your universe suddenly shrinks because few people have great reinvestment capacity. But if you're going to hold things indefinitely, you have to have the reinvestment engine, and that requires that you look for certain companies. You probably want to eliminate agency costs as best you can, and the agency cost that's most corrosive is that cost which is the uninvested opportunities that most public companies fail to exploit because they're too tightly titrated to quarterly earnings and to the plaintiff squeals of activists. And so they can't do what's right, except for a very small subset, which I have found, and I think Warren has increasingly discovered, exists in the reach of family-controlled companies, where the families are in control of the destiny, and they can send off people who complain about quarterly burdens because of long-term investments. And that's an agency cost I think is well addressed within Berkshire, and it's something that I try to focus on with something like 70% of the businesses I own are family-controlled. And that, I think, stretches out their duration. And I guess those are the main observations I've taken from Berkshire over the years.
So let me maybe reframe the question for you, Tom. Let's say I'm a prospective investor,
yeah,
and I come to your firm and I say, I've heard good things about you. I have $25 million that I want to put to work. What do you ask me to protect yourself against the risk that I'm a bad client for you that you wouldn't have asked me if you hadn't learned these lessons from Warren Buffett?
Well, I think it's just, I think Seth referred to it. It was just the hard wiring of human nature being such that people can't tolerate being out of step with markets or facing what seem to be temporary risks has informed my practice in one very major way, or 2 ways, I guess. First, 70% of my investors are taxable family offices, and so they care about tax deferral, and so they wouldn't welcome me to enter into more hyperactive activities than waiting 4 years to buy a stock. So first of all, you choose your investors to be taxable so the alignment of interest exists. And then what I've done over the years is I've argued for the $25 million client to give me a very small portion of their funds because I don't want to have to face the emotional swings that come from having overconcentration. So if somebody in a situation like that gave me a small portion of small enough that they can ignore me over a long period of time, I think we can add value. But if I'm managing that full $25 million, I am dead because I have to perform every quarter with every market swings. And so I actually, in a fairly wimpish way, just ask them to deliver a very small portion and wish them well in finding other managers.
How important is it to each of you to fire clients who turn out to be too short-term? Whitney?
Jason, can I ignore that question just for a second because I want to add something on to what Tom said. Tom said you've never sold a Berkshire share, Tom, is that right?
It's always stayed at the same allocation, whether there's capital ins and capital outflows.
Yeah, because look,
nothing to say, now it's reached my target price. I got to get out of Berkshire.
Yeah, and it's an interesting question, both as it relates to Berkshire, but almost any long-term investment that you have confidence in. Tom's obviously done extraordinarily well, finding a winning horse and riding it for decades. And he's a lot more successful than I am over time, so you should listen to him. But I'll tell you what I've done over time is yes, I have some emotional attachment to Berkshire. It's the only stock I will admit to having some emotional attachment in my portfolio. I try to be as objective and unemotional as possible, of course, with virtually all of my investments. But like I said, Berkshire's range from a 3 to a 30% position in my fund. If you look at the chart I have in my presentation, which basically goes back to 1996, and each year I calculate intrinsic value using the same methodology I outlined in my opening comment, and then I map it onto the stock chart. And what you can see is that, like any stock, it trades wildly up and down. There have been how many 50% drawdowns do you say, Tom? A lot, a half dozen or so, right? And so there have been, in my 17 years that I've been running my fund, there have been 5 spectacular times to own Berkshire when it was basically a 50-cent dollar. But there have also been times when it's traded up close to intrinsic value, and from that point, if you look at the chart, you'll see that the stock is generally sort of languished. It's sort of flatlined. When it gets up to intrinsic value, Buffett is in favor, these kinds of stocks are in favor, and you don't make any money for 2, 3, 4 years. And that's when I've trimmed Berkshire back to be maybe a 3% position. So today, as a simple example, if Berkshire very quickly rose to $250,000 a share, it appreciated 25% from here, it would then become, instead of a 5.5% position, a 7-ish plus % position in my fund. And the discount to intrinsic value would narrow to well under 10%. Both historically speaking, and I would argue logically speaking, I would be trimming that back to maybe back to closer to a 3% position, taking some profits because surely I can find something better out there in the market, particularly as a small fund, than a 95-cent dollar, as much as I love Berkshire. So that's how I think about sizing, and I don't consider it trading so much. These aren't short-term trading decisions. But, I sort of like to be prepared and have a smaller position, and then sure as shooting, every few years, the market gets stupid on Berkshire, and I can buy it at a 75-cent dollar or less, and that's when I want to load up and make it a bigger position.